The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening.
Hello and welcome, everyone. Thank you for joining us this morning. For those of you who don't know me, my name is Aadil and I'm a licensed financial advisor and co-founder of Own Financial Planning. Joining me today is my business partner and co-advisor, Dane Pymble. Just some housekeeping before we begin. We like to keep the sessions interactive, so please really participate via chat or going off mute when we stop for questions. Feel free to turn on your camera. This will make it a more human experience for all of us. Before we get started, please note any opinions or recommendations we discuss today would be general advice only. If you wish to act upon anything you hear about today, we strongly recommend seeking advice from qualified professionals prior to making a decision. Now, if this is one of the first time you're joining one of our workshops, then just a bit about us. At Own Financial Planning, we have one simple philosophy when it comes to money. It's that life is more than money. Money is simply the tool that enables you to live your best life. So it is our mission that in all our advice, we aim to align money decisions with key life decisions to help our clients lead their best life. And the basis behind our advice approach is centered on Dr. Margaret Swarbrick's research on the 8 dimensions of well-being. We believe that overall well-being is a healthy approach to living. It could mean doing purposeful work, enjoying good relationships, eating well, having a work-life balance, and of course, financial well-being. Our focus this morning is certainly going to be on the financial well-being pillar, and we're really thrilled to have some leading market experts to share their insight with us. So we'll kick off firstly with some insights into the property market with Arjun Paliwal, founder and head of research at Investorkit. Since 2018, Arjun and his team at Investorkit have completed over $1 billion in property transactions and helped investors purchase over 1,200 properties Australia-wide. Investorkit are the only back-to-back Buyers Agency of the Year winners in 2023 and 2024 in the Australian history by real estate business. So before I hand over to Arjun, however, we'd like to do a quick poll, which will come up on your screen now.
Give me a sec, Aadil.
And Dane's going to bring up the poll, which should come up on the chat as well.
Sorry, mate.
All good.
Apologies, Aadil. I've seemed to have lost that for some reason. Here we go. My bad.
Great.
Just bring that up now. Can you see that? Does that come up, Aadil?
Yes, comes up for me. Hopefully it comes up for other participants. Yeah, keen to get your insights before I hand over to Arjun.
Excellent. Quite a diverse spread here by the looks of it.
Let's quickly share the results as well, Dane, if results are coming through, and then we can hand over to Arjun.
Sorry, mate. For some reason, I'm having an issue sharing the poll results.
All good. So do you want to provide a commentary on what you are seeing?
Yeah, sure. So basically, it's a pretty even spread. We've got I've got a few for Melbourne, a couple for Brisbane, Adelaide, regionals, and then one in Sydney and one in Perth. And then if you wanted to pop in the chat, someone's left a section for other as well.
Great. Okay, maybe then I will now hand over to Arjun to share his insights and view on the property markets. Arjun, I'll stop sharing and over to you.
Fantastic. Firstly, thanks everyone for having me on and the kind intro as well, Aadil. Appreciate it. Today, I wanted to get stuck into talking about Australian housing fundamentals. I will share my screen in a second, but just to give you some insights, Australian housing fundamentals became a big focus for us when we realized the mass public and the media often get it wrong by understanding what drives property markets. And the biggest mistake most people make is they use a singular indicator, thinking that makes the difference for everything. And just to give you some examples, interest rates are high or increasing, therefore X happens. Or migrations coming in, therefore X happens. Or infrastructure is being built at large levels, therefore X happens. So there's a big flaw with this type of approach, which is approaching it with one singular thing, hoping it makes the difference to everything. What we've uncovered is that property fundamentals, there's about 25 fundamentals that exist in Australian housing. And these are the macro fundamentals, meaning they're the things that drive, major cities. And then underneath that naturally will be the micro parts, which I'll touch on. So that's what started it for us in terms of giving everyone some insights. What I'd love to share, though, is a bit of a starting point, which is how did we go last year? Because this report, we actually released this report last financial year, and this is a rerun for this financial year. And so when we release this free report, by the way, you can download it for free on our website, investorkit.com.au. But with regards to this last year prediction, we had what are fundamentals, what we think is happening across Australia at a macro level, which fundamentals are scoring strong, which fundamentals are scoring balanced, and which ones are weak. And then lastly, what does it mean for the 25 largest cities across Australia for their growth rates? And so we used a traffic light system to say high pressure, strong capital growth expected, balanced pressure, okay capital growth expected, and then low pressure, which is either slight declines or just above flat line. And in doing this, we actually reflected now, because the beauty about data is that it's easy for everyone to make predictions, but you can also see if you go back how well they were placed. And in this particular case, we had 12 cities that we scored for high pressure. And with those 12 cities that scored for high pressure, they achieved 9.5 to 16.5% growth rate. So definitely boom times over that year. And then the 10 cities that we scored balanced, they saw between -2 to 8.9%, and 2 even declined. And then of the 11 cities that we scored low, 10 out of those 11 cities actually scored less than 5% growth and 6 declined. So you can see there's validity in this type of measuring approach of market pressure to forecast and using fundamentals to analyze that. So this is a bit of what we said last year, which was some of the stronger markets were definitely likely to be around WA, SA, and even regional Queensland as the big winners. And that's really what we saw over the last financial year, the biggest growth markets there. So that's understanding how fundamentals and pressure come into the mix, just to share what we predicted. But now let's go into actually what fundamentals mean. So I want to jump into that. But before I do, when I say some of the biggest cities we analyzed the major cities here, obviously the capital cities and some of the largest city centers across the nation when it comes to our regional markets. All right, so what are fundamentals? Firstly, we break fundamentals down into 3 parts. The first part, underlying demand. The second part, supply. And the third part, confidence. Other people use words like sentiment as well. Now, you can see there could be many sub-data points, but if you just go focus on the simplicity of what each category is, it's people movement, economic activity, finances, and affordability. So these are what represent demand. In supply, it's current supply, so listings for sale, listings as a proportion of total stock, established housing, and then there's incoming supply, which is how many properties there are available for rent soon in the future based on our forecast, or how many properties there are in construction. This is both a supply for rent and for sale. And then lastly, confidence, whether it be consumer sentiment surveys, whether it be behavior of consumer sentiment and spending data, or whether it be media cycle. So is the media more positive? And I've got something really cool to share there. So we've got our own internal tracker where we actually track keywords going across the internet for the 5 biggest media producers in Australian mainstream. And we constantly categorize them using AI into positive, neutral, or negative news. And so we've got trend lines internally to see how is the news actually becoming. Are they turning to be more positive? Are they becoming more neutral? Are they becoming more negative? And it's interesting to see the impact that does on consumers across Australia. And then there's government intervention. When you unpack some of the jobs growth or investments growth across the last few years, it's just unreal as to how much the impact the government makes in that space. And that's the core parts of fundamentals. I won't go into every micro detail, but with the micro details, this is also found as to where some of the data sources are. So you can see some of the validity to all the data going through it all in the report as well. Let's move on to what market pressure means. So fundamentals are macro. They're what drive major cities. They're what drive the country. But we always have to remember, if we're ever looking at housing, when you're making an individual housing decision, you're buying one house in a street, in a suburb, in a city, in a state, in a country. So what that means is you are buying one house, right? You're not buying the country when you buy housing. And so the goal there is to understand macro is great, but it's more a knowledge base. It's the why understanding, and it's what's happening at major market levels. It's market pressure, though, that truly defines the success of an individual investment. And market pressure can be divided into two categories: sales market pressure and rental market pressure. And to give you the non-jargon version of these, it's how much something costs, how fast is something selling, how many transactions occurring, how much discounts do sellers give when they're listing to sold, how's the long-term performance over 10 to 20 years, how's the short-term performance in price over the last 1 to 2 years, how much is the available properties on the market for stock, and how much of that is a proportion of total stock there. How many rental properties available in terms of as a percentage of total rental stock, how many total rental properties available, how much the rent is for, and how much is the rent as a proportion of the purchase price. And then there's other indicators, which is how well auctions are going, how much construction there is, how much online internet search there is on areas. These are what we call market pressure. Because fun fact, there's never been a market in Australian history that's grown in value over the last 40 years of data, but it's seen low pressure. You cannot have capital growth without pressure. So that's the most important thing to understand, that if you want the cheat code and you don't want to be confused in the macro, you can go down to the most micro of a suburb, and if it's got no rental properties, if it's got high rents, if it's got an affordable price, if it's people selling way faster than last year or years before, if lots of people are buying, if there's no stock available, prices only have one direction to go. And in history, 40 years plus of data analysis, we've never seen all strong indicators that market pressure occur, and the market did not grow. So that's something really fascinating. Now, the last few parts here is actually going through what some of the fundamentals are. Now, it's important in this score that you understand two things. Firstly, at Investorkit, we're researchers at heart that just happen to buy property, right? Not property agents. And this is something really important to understand, because you're going to see what I think, first time ever, right? A property person says is bad about the market. When have you heard that, right? Property investors or property companies going, oh, this is not good. No, everything's rosy in the property world to agents, unfortunately. And so I think the key here is to go, what's going well, what's not going so good, and what's going pretty poorly. And that's how you truly have a holistic view of fundamentals. Second thing, this data is a once-a-year major release. It's an in-depth report. I think it's 60 plus pages here in this report. But the main thing is it's in-depth. So we do this once a year. And a lot of these stats, they're slow moving. So even if some changes occur and the stats aren't perfectly accurate to the month of November, they are released in the July onwards period. So you should still be okay in the trend analysis of where these stats are going and what they're doing. So let's firstly talk population growth. Obviously, that's been a big part in Australia, and they've been quite strong with overseas migration. However, one mistake many people make in analyzing this trend, you would have seen news and many uninformed or uneducated consumers go, oh, look, 1 million people came through. People forget that in 2020, no one came through. So if you divide the million across another year, it actually comes back to the normal curves that we were getting pre-COVID anyway. It's just made huge in the news, and it's also made higher in terms of pressure just because we have less housing, right? But in terms of the actual number, it's not massively more than what it was pre-COVID. It's taken the no year of COVID and added on to the year after, but then they just haven't come off that rate. It's still pretty high, but they just haven't come off that rate, right? So that's strong, which means there's an underlying fundamental that's healthy there.
Right, yeah.
Obviously, this is across net overseas migration as the main driver, but then there's also births and deaths as another one. Net regional migration is quite strong. So COVID wasn't a boom in isolation of regional markets. COVID has seen that spike of people moving to regional markets, but that has still sustained to be some pretty strong levels. So something there important to understand is that with COVID, it didn't just spark this regional trend and it died out. The regional migration is still very strong across Australia. Then there's international visitors. That's improving, but as you can see, not super strong. I do think that the relationship with China hasn't been the best for recent years, and I think international visitors from there haven't been as strong as they once were. But visitation is still strong overall, but just not strong in the most years that we've had in the past. And then this is an interesting one that many people forget. People sometimes think that the rental housing crisis just came out of nowhere, and or it was just the policies against investors. That was one big part, the policies against investors over the many years from 2015 onwards, reduced rental stock in the market. But here's another one. Household size actually decreasing was also one that actually impacted the rental markets across Australia. And to just visualize this, if you have a household size of, say, 4, and that reduces to 2, the same household with no new population growth has had 2 people leave to create another household, and that first household has 2. So essentially, you've doubled the rate of growth in population spread, even with the same number of people. So household size reducing can actually massively spread housing demand across Australia. So that reduction meant that it was quite strong, right? And that's also happening as more of a demographic shift because the millennials are getting into family formation stage. Now, although if you ask me, an Indian guy, we don't really move out as much as the others do, but that's definitely a thing that we see, which is more people moving out at this time because of the millennials coming to family formation stage, and that's what shrunk the household size down, right? And so when we look into the next part, economic activity, and I'll go through these a bit quicker, but GDP growth, this is being weak. So this is me telling you that the economy is not in a pretty space. There are some metrics where the economy sits strong, but metrics like this aren't pretty. And so that's just one number to show you straight away that not everything's really, really strong. Unemployment rate, today's data is a little bit higher than this one, but it is still quite low in the grand scheme of things. So I would still keep it in the strong, maybe dial it down a little bit, but it's still at a strong number. Infrastructure investment is huge. This is truly an infrastructure boom across Australia. One that's largely led by government, though, not as much private as we like to think is happening, but it's a lot of government spend across the country, which has been massive. Renewables have obviously been a big focus in Australia. A lot of roads and defense has been a huge focus over the last 5 years as well. Commodity prices have changed since the starter point here, but just gives you an insight of that and its importance as well. Moving to finance. So finance cash rate, not pretty. And being that high is causing a strain on households, but the forecasts are that over the coming years, this comes down pretty quickly as we go into 2025, right? So that's some of the key things to think about, which I'll touch on at the end as well. Household income. So yes, inflation's been high. Yes, wages is always a context of a key part of conversation where it hasn't kept up with housing. But the key thing is wages have been increasing quite strongly, not massively on a net terms because of how strong inflation's been, but it has increased strongly as a number when it comes to the recent times, what we've seen. This last data point on the income and savings, this has been pretty disappointing. This is my thoughts of why interest rates shouldn't be here for much longer. And if they do, you're hurting the Australians a lot more. The key is household savings ratio. So long-term averages are about 8% of disposable income sitting into saving ratios. But then peak periods at COVID hit about 16 to 20%. So lots of cash flush that happened around that time from stimulus and spending not happening, traveling not happening, conservatism, an event we hadn't seen before. But as soon as interest rates really started piling up and the world started opening up again, this number shot down and the interest rates have moved extremely, extremely low. Now, it's still technically positive, which means we aren't going backwards, but it's as close to backwards as you could be. So hence another number suggesting we should not be sitting here with interest rates and it should start turning around in the coming years. Well, this is an interesting one, finance. So we would think that finance with interest rates being so high would mean loan commitments and take-up comes down. There's a difference between finance capability and finance take-up, right? Finance capability is no doubt a part of finance take-up, but if people still have a capability, just not as high as before, and they wish to take it up at higher amounts, that's still strong demand. So what happened was clearly a lot of people were active in recent times in the finance world to get, money towards housing, investment, or living in. It's just that it's harder to get it, but the desire to get it is still very high. And so that's why the number still rose. Another big fundamental, residential valuations in terms of loan to value ratio, very, very low. People forget this. It's a surprising statistic. Over $10 trillion in value in the Australian housing market and under 25% of mortgages on that value. So Australians are extremely fundamentally sound in property, which is why you can't compare us to many other parts of the world. Even when we talk about how crazy our property prices have risen, it's because a lot of the driving factors have been owner occupiers, not investors like many people believe. They sit on little to no mortgages with, close to a third of houses having no debt at all. And this just shows that it's a very strong position. So overall, that's that part. And whilst bank delinquency rate is a little bit is increasing in recent times, it's still very low. It's still a very strong number. So we aren't seeing huge amounts of repositions and defaults. So that means the mortgage cliff media mania was all a bit of a false alarm over the years prior. Borrowing capacities dropped down by at least 30%. So not a strong amount of borrowing there that's happening, but the desire is still very high. And lastly, we'll just go over to affordability. I think naturally when rents have risen as much as they have, rental affordability's dipped a lot. So even though vacancy rates still exist at tight levels in Australia, we're not seeing rents rise at the same pace. And that's because while supply is low, it doesn't just mean you can charge much and everyone comes along. Supply is low. People are trying to charge this much, but they can't charge as much as they once were and increasing. So rents are just calming down in their growth rates. Mortgage affordability, price to income ratios, they're not going to be pretty with interest rates the way they are. And here's the big part of what's keeping the fundamentals strong. Very low levels of supply. That number has increased a little bit since, but it's still be in the strong category, and very low rental vacancy rates and not a lot of construction. And so if we finish it up with that media cycle score, it's balanced. The media isn't too crazy about property just yet and not too weak from our indicators of that cycle analysis that we did. And there's a lot of government intervention happening, and sentiment, it has updated and improved a little bit, but still fairly weak across the country. So overall, when it comes to our fundamentals, we did feel that with 16 out of 25, they are strong going into the next year. But here's the crazy thing. While 16 out of 25 is still a strong score, the boom periods of 2021, to give you some context, was 22 out of 25. So you can see when that period happened, it was really strong. But if we see how many of these indicators are tied to the interest rates and how people are feeling about their households, sentiment will improve as that comes down. Mortgage affordability will improve as that comes down. Borrowing capacity will improve as that comes down. Household savings ratio will improve as that comes down. Cash rate improves as that comes down. So that's already 5 layers of improvements from a score of 16, taking it to 21. So if all the other trends can improve or stay where they are and cash rates start to come down quickly, we could see another surge in housing values in certain areas because of those 5 scores improving, taking it back to 2021 fundamentals, 21/22 out of 25. So for the purpose of time as well, I'll stop there, and hope you all enjoyed my wrap here on fundamentals. And this is all thanks to myself at Head of Research, but mainly though, my team in the Investorkit, the data scientists we have, the research analysts and the senior research analysts who put all these insights together. And I just get to take the credit at the end for it, but really it's all them.
Thank you, Arjun. And I think we can kind of take some time for Q&A from the audience. So yeah, please feel free to kind of put your question in the chat or go off mute and ask Arjun your questions.
Just while everyone's doing that, thanks very much, Arjun. That was a great presentation. One of the data points that I saw in your presentation that really interested me, actually quite stunned me, was the low level of residential loan to value ratios. Question on that, how far back does your data go? Does it go back pre-GFC, and kind of where is that data set, or where is that sort of ratio got to at the peaks of previous cycles?
Yeah, so I haven't got the peaks of previous cycles in front of me, but it has always been trending down. Until recent times, it's picked up a little bit, but overall, it's trending down, and it hasn't been a high number. I think naturally, the more and more decades you go back, the higher that number is, because housing was established and growing in Australia. But now that so many houses are set into the mix, it's only really the new build housing where higher mortgages get taken up, and a lot of the established housing, where Australia's majority of its housing is, where it's now over 10.4 million dwellings. Those houses being established are where not a lot of debt sits. So I think this is a big part. Like, people aren't going in there and taking huge amounts of mortgages to buy their next place. A very common move is someone who may have a $2 or $3 million home in Sydney, has been there for a long time, has seen that being reduced or paid off over time, and then they've downsized, and they actually still have gone to compete at a high level of pressure in that cheaper market so they can push up that price as a result of that competitiveness, that strong position in their financial power. But then they don't have any mortgage when they end up settling on that price. So a lot of transactions, even if someone wants to check out the PEXA report, huge amounts of transactions across Australia actually get settled in cash, and mortgages aren't as big of a business as everyone seems to think.
Great. Thanks very much, Arjun. And yeah, for those on the call, I know I'll be talking about market cycles, and one of the key things that drives major downtrends is that credit element. And so it's really interesting what you're highlighting there for residential property in Australia, is that it's not anywhere near as big an issue right now as some of the media or economists may sort of publicly suggest.
Yeah, absolutely. And I might give one really interesting data point, which was a big leader for us, predicting that there would not be a mortgage cliff with the interest rates rising, because that was a big topic, right? In 2022, the rates really started to shift. So what we did is, if you have a look at it, everyone seems to think, oh, all those people with the COVID cheap money, they're going to be hurt now. Watch this space. But if you think about it, the 2 years of that super cheap interest rates were only representing 500,000 transactions per year times 2 years, which means 1 million transactions. And if you think about it, with 10.4 million dwellings, 1 million transactions, less than 10%. And then of those million transactions, it's not like all of those million transactions were new first home buyers, right? That only represents just over a third of all the transactions. A lot of them would have been homeowners switching, downsizing, upsizing, maybe investors adding an extra one in the portfolio. The main thing, though, is that the whole million of interest rates taken up in that transaction base over 2 years wasn't all new people who've never felt higher interest rates, right? Or who've never been impacted by that. And so I actually went on with Mark Boris on the show, and I actually said to him, hey, I don't think we're going to see a huge impact from the interest rates increasing with all this impact of the cheap money coming off. We're not going to see any mortgage cliffs, and we are going to see Australia recover into 23 onwards. And the key thing there was that when taking those percentages, we only get down to about 3% of total dwellings in Australia that would have been first-time users of cheap money during COVID money. And so the key there is a lot of people had no mortgages. A lot of people knew 5, 6, 7, 8%, 10% plus interest rates from back in the day. And so the key thing there is that Australia's mortgage position isn't as high, and that's not as big of an impact as everyone makes it out to be.
Great response. Thanks, Arjun.
One question from me, Arjun. As you look into 2025, what are you expecting the market to do? Maybe at an overall level, if you'd like to speak, or maybe at a regional level, like I'll leave it to you.
Yeah, of course. So with 2025, our forecasts are pointing to what we call a big divergence. And that's really important because we've just come off a year as a boom where everything's been booming, right? And in recent years, maybe 2024 is probably the first one, and parts of 2023 is where trends are starting to split. So we've got one aspect of capital cities which will continue their boom into the next year: Perth, Adelaide, and Brisbane. They're extremely undersupplied, and they're seeing that housing demand still remain at high levels. So we're expecting between 8 to 15% of growth across those three markets, depending on which city you choose, is how much it sits in the range over there in that terms of that divergent bucket. Then you've got this bucket here. This is where the Melbourne, Sydney, Darwin, Hobart, and Canberra sit. And we do expect prices to be fairly soft in those markets and not beyond 5% of capital growth in any of those cities over the next 12 months. Some may even be close to zero. Melbourne, Sydney is an example, but you can look at that in two ways. You can look at that as okay, I'm an investor seeking a buyer's market to enter in and negotiate in better times. Or you can look at that as it's a great way to, buy and hold for the long term and not feel so attached to the FOMO that exists in some other markets. It's all dependent on what your portfolio has, which is why even in those polls, whilst we can have a thought, it's actually your thought on your portfolio that could matter most, not the thought of the market. So that's the key.
Thank you, Arjun. Okay, maybe we have time for one last question from the audience if anyone has. Otherwise, we will thank Arjun for his time. I'll just see, Arjun, let's see if there's any questions. Anybody being brave enough to ask a question, put something in the chat.
Can I ask a question about Perth?
Sure.
I think it's come out of the media that's become one of the most unaffordable cities in terms of property. What is driving that, and what's the longer term view on housing in Perth given the mining downturn there?
Yeah, so this is a good question. So firstly, I would respectfully challenge the notion of its affordability. It's actually still very affordable at a level to locals. When we think of the growth, we think of this is huge meteoric rise over the last 3 years and go, wow, some areas have close to 60 to 100% in the last 3 years of growth, which naturally makes this like sensitivity in someone's mind of affordability because it's grown so much. But people also forget that it's declined in value from 2013 to 2020 by close to 25%. And so if we take a look at a 10-year basis, Perth's just risen as much as all the other capital cities have and not much more. But it's just this acute 3 years that has seen it boom like crazy and which has made the affordability conversation come up. In terms of mining, it did have a greater impact the last time around in Perth. It's having an impact. You can't say it has no impact because it's a key part of that state, but it's having much less impact this time, largely due to how undersupplied the housing market is. So if the undersupply of the housing market is this much undersupplied, where there's 50% plus reduction in listings for sale, even let's just say some scary number of 5 to 10% of certain workforces get impacted and jobs get cut, it's just fighting a trend that's too strong where so many people aren't selling their homes. So that's one aspect. The second aspect is we've seen much more diversity and focus in Perth over the recent years, which has been around things like roads projects, defense projects, and going even further to more recreational projects going down south. The key there is that it's not the same as it once was, but its mining is still an impact to the state. How I look at Perth whenever I think of investors' portfolios, I always think of it like this. If you've got a few properties in your portfolio across different parts of the country, going to somewhere like Perth isn't an impact negatively to you, even if the mining has some ups and downs, because you've got the diversity. But if you're a first-time investor with no chance of getting some others over the next few years due to income limitations or other things like that, then it might not be the best choice for you to be the first property in that type of market where you don't have as much of a diverse portfolio, just because volatility, whilst it's happened in the past, and we don't expect it to happen to the same levels in the future, it can still happen. An economy doesn't change overnight.
Thank you.
I guess, Arjun, we have one final question on the
Right.
chat, and then we can move on. So in the chat, we have one question. From Lisa? Can you comment on townhouses and apartments versus houses?
Yeah, very interesting question during this time of like the cycle as well. So as we know, the gap between apartments, townhouses, and houses has been the biggest it's ever been in Australian history in terms of the price gap. So for affordability sakes, those townhouses and apartments are looking very attractive, but buyer beware of a few things. The key is that many people can get lured into the short-term gains being a gap, and they want to see the gap close and see it as almost like a share where they think the value gap is there, or a business and they think there's a gap there they want to bring up. Well, the main thing is a gap can be caught up, don't get me wrong, and you can outperform for a couple of years, but there's a 40-year trend line that shows it performing worse than houses. So the main thing is for apartments I'm focusing on now is that they have a 40-year trend where they've underperformed houses. So even if it comes and closes the gap, you might win in a few years, but Australia is not a good location as a country, to win in property just for a few years. You want to hold for the long term. And I'll tell you why. Stamp duty, buyer's agent, lawyers, pest and building on the way in. On the way out, capital gains tax, sales agents, lawyers, and many more maintenance, marketing. So the thing is, we lose between 6 and 10% transaction value in the country just from in and outs. So I think the main thing there is if you're hoping for a short-term boost, apartments catch up by 20%, guess what? You still have half of it gone and eroded just in transactional costs. So Australia is one of those areas, by all means, go get great growth in the short term because you can use analytics to better time your position, but don't look at it just to catch up a gap and then suddenly you're back to 40-year trends that are worse than houses. So that's the apartments comment. With townhouses, very, very, very unique. Townhouse data in Australian property is pretty poor. So even as a research firm like us, even with us spending over $500,000 each year on our analytics, we are still not super confident on townhouse data. And so neither can the biggest players because we use their data, the CoreLogics, the Domains and others, ABS. It's just not as clean yet. It will get cleaner. In some cities it's clean though, like Melbourne. There's a lot of frequency of townhouses there, in parts of Sydney. I just think the main thing is with townhouses, yes, I would attribute it more to houses than I would apartments because of the land component. But with the townhouses, what's making it difficult is just I can't give the same sense of a 100-page report like I have on housing fundamentals to a level of townhouses, just because I don't have enough data just yet. We can say that those trends follow houses a little bit more closely. So if budget's a bit of an issue and you're not buying in a block of 100, 200 cookie cutters, and you can get some sort of, positioning similar to a house, might not be the worst investment from that perspective.
Thank you, Arjun. That was wonderful. And thank you again for making the time to join us this morning. I think those were wonderful insights. Hope everybody got something valuable out of the session. I will now keep us moving and move on to our next presenter. So thank you very much, Arjun.
Thank you so much. See you, everyone, and really appreciate you having me on. And with regards to connecting with me, I'm always on LinkedIn, Arjun Paliwal, and I'll see you there.
Thanks, Arjun.
See you guys. Bye.
Okay, moving on to our next presenter. So now we have Marc Jocum, who's an investment strategist at Global X ETFs. Marc has worked for over a decade in the ETF product and investment space with leading institutions such as AMP, Morgan Stanley, and StockSpot before joining Global X ETFs last year. Global X ETFs was founded in 2008. For more than a decade, they have been empowering investors with unexplored and intelligent ETF solutions. Their product lineup spans disruptive technology, equity income, commodities, and more, and they strive to offer their investors something beyond the ordinary. Global X is a member of Maret Asset Investments, which is a Seoul-based global enterprise which offers asset management expertise worldwide. Before I hand over to Marc, a quick poll again, which will come up on your screen now.
This time, Aadil. I think I've got.
Let's see. Fingers crossed.
We'll see. We'll see. Right. All right. The question.
There we go.
Questions are up there now. Annoying that the host, I'm not allowed to vote on this, Aadil. My views will probably come out in my presentation.
Are we going to have better luck sharing the results?
Yep, I'll just let the answers come through because I can't share it until the polling.
Perfect. Right.
I think we've got a bunch coming through now. That's this one's a bit more concentrated, Aadil. I'll share it now. Interesting. Last poll was quite sort of diverse. This one, very much a competition between AI and critical minerals, with a little bit of cyber.
Wonderful. Okay, I'm sure Marc will have his own insights on this. So with that, Marc, I will stop sharing my screen and over to you to kind of, I'll take it from here.
Thanks, Aadil. Thanks, Dane. And hopefully everyone can hear me. I had a few audio issues before, but I've got the trusty headphones on. And no, that poll's actually very interesting because the two topics around critical minerals and AI are two, I guess, elements that I want to really focus on for my presentation as well. So I just wanted to say thank you for having me. I've already got the great introduction already, and I'll be sharing my screen. I'll be presenting for around about 20 minutes. Keen to make it as interactive as possible. So please, if you've got any questions, I'm very happy to answer it at the end. I want to keep it short and punchy, but also give everyone on the call today who's taken time out of their day some valuable insights and some golden nuggets that hopefully can help with portfolio positioning leading into next year, and just some interesting insights on what we're seeing, our house views, and some investment trends overall. It wouldn't be a presentation without a mandatory disclaimer. So anything I say is general in nature. If you do want any more information about our funds, jump onto our website where you can read the product disclosure statement or the TMDs, the target market determinations as well. Aadil already gave me a great introduction into Global X, but yeah, we're a leading ETF issuer here in the Australian market. We're owned more broadly from a global standpoint by a large Korean asset manager who has north of $500 billion under management. And we've got over 400 ETFs with close to about $100 billion US in assets under management. A lot of you may be familiar with some of our offerings. As Aadil said, we do specialize in the thematic growth area. I'll be focusing a lot of my presentation on that. But we do have a range of other ETFs available in the market as well. Across commodities, income, even cryptocurrencies as well. And we're now managing, close to $9 billion across more than 40 strategies overall. So I wanted to first give a bit of an update of the lay of the land of what's going on in markets and some of the things we're seeing, and then present a few investment ideas that you may want to consider. I think Arjun did a really good job at the start around presenting what's going on with the inflation cycle at the moment. But what's really interesting is we're going through this global easing cycle, as the title on the screen says, but it has commenced globally. And now the question really is how far and how fast do economies want to go? And you can see on the chart on the left-hand side of your screen, the orange line is the key outlier over there, because all other central banks, at least major global developed banks around the world, have started their interest rate cutting cycle. Australia is yet to follow suit. I know Arjun was speaking before about the need to cut. And I think if you look at the chart on the right-hand side of your screen, you are seeing that inflation is heading in the right direction here in Australia. We had the monthly figures that came out yesterday from the ABS, which showed that inflation at a headline level is progressing in the right direction at 2.1%. So that's at the low band of the RBA's target band of 2 to 3%. And that's the lowest level we've seen in about 3 years. However, when you look at the trim mean inflation, which kind of strips out a lot of these volatile moves, you're actually seeing it increase up to about 3.5%. And I think that's where you're going to see a lot of focus from the RBA on probably the quarterly information that's coming out. This is just a monthly gauge. They really pay attention to the quarterly information, which will come out later. And I feel while waiting for that information, particularly for the December quarter, I think that even gives more of a reason for the RBA to potentially keep rates higher for longer. And I think that even though this disinflation era has started in Australia, it's still lagging, and you've got services inflation, which a lot of you may be feeling, rather than goods inflation, still quite sticky at about 4 to 5%, whereas goods inflation is relatively flat. So I think there still could be a risk to the rate staying high for longer, just in case there's a large expected fiscal stimulus, especially leading into an election year next year in Australia. And also, we still don't know the full impact of the US tariffs overall. A lot of the market was saying, well, there's going to be cuts this year. That hasn't happened. A lot of saying there's going to be cuts in February next year. I've had a look at what some of the markets are predicting, and some have moved it out to May at the earliest. So I think that they're going to stay a little bit higher for longer. And as we start to see unemployment tick up a little bit, the inflation, especially at a core level, tick into their 2 to 3% target band, that will probably give room for the RBA to move. And why we focus so much on interest rates is I think that markets tend to react differently based on the interest rate cutting cycle. So what I've got on your screen here, there's lots of different numbers, but it shows the past interest rate cutting cycles and how markets performed over that time. And you can see that it is quite different depending on depending on the economic conditions or the reason why the RBA or the central banks may be cutting. If you look at the oil crisis back in the 1970s or the late 1980s rate cut, you really saw that markets rebound driven by optimism. Whereas when you look at the rate cuts that happened during the dot-com boom or during the global financial crisis, that was really driven by economic weakness, and that outweighed the benefits of lower rates. So that's why the performance can be quite mixed. If you see during a cutting rate cycle, the average performance is actually from a negative perspective, but sometimes you do get positive. And then leading into the year after the rate cuts, normally on average, markets actually do quite well. So I think when we look at the current trends at the moment, I think that the interest rate cutting cycle is going to be more gradual than it is going to be aggressive, which is kind of analogous to the late 1980s rate cutting cycle. And it probably indicates a bit more of a controlled and stable environment. But importantly, we are cutting into an environment where financial conditions are loose. So I still think this bodes quite well for investing, particularly in equities. And I still think there's a pretty bullish environment overall. When we think about more broadly what's happening from a macroeconomic standpoint, we do look to the US. They are, in terms of the economic leaders, in terms of economic indicators, leading compared to most nations. And when you look at these areas, we tend to focus on something called the 3 Ls, which is labor, leverage, and liquidity. So a lot of charts on your screen, but I'll take you through each one. The first, we look at labor. So the top left-hand chart shows that the unemployment rate is still, it's actually the same as Australia, 4.1%, still incredibly low. And that gives reason for, I guess, the labor market being quite tight. not just that, but the US labor market has added, they added 12,000 jobs last month. We'll see what happens this month. And a lot may think, well, 12,000 doesn't sound like a lot, but that's actually 46 consecutive months of job growth in the US. And that's the longest stretch that we've seen since record keeping began in the early 1900s. So the labor market is still quite strong. The 12,000 was mainly due to the Boeing airstrikes and also some of the unfortunate natural disasters that we saw in the US, but things are still looking good from a labor perspective. Leverage is really around the level of debt, and household leverage continues to decline in the US. They have gone a little bit harder in terms of interest rate cuts from the Fed, but you got to remember that in the US, and I know Arjun was talking a lot about the impact of the property market over here. In the US, most of their loans are 30-year fixed rate loans. They don't have a lot of the variable rate loans that we have here in Australia. And I read a crazy stat that I think it was over 50% of loans that are in the US from mortgage holders have an interest rate that is below 3%. So even though the rate hikes did come within the US, a lot of people refinanced during the COVID-19 interest rate emergency cycle. So did corporates as well from a leverage perspective. They've also been deleveraging their balance sheets. So corporates are actually in a really good position at the moment. And then the final L is liquidity. And that liquidity aspect really refers to the financial conditions. So you're still seeing conditions quite loose from a real wage growth perspective, both on the lower end and higher end. You're seeing meaningful wage growth, which is great to see. Elevated stock markets bodes well for people who have high investable assets in the share market. And then profit margins overall, which is the final chart on the right-hand side of your screen, shows that, especially in the US, we've seen 14 straight quarters of profit margins of more than 12%, which has never happened before. Versus in Australia and the rest of the world, we're seeing a few profit margin decreases happening overall. So normally this is associated with layoffs or people cost cutting, but it's actually different. There hasn't been a crazy amount of mass layoffs, but it's rather new tools, new efficiencies, the use of technology, and we'll touch on in a moment, artificial intelligence, which is really improving a lot of these profit margins for these companies. So that kind of paints a picture quite nicely for why investing, particularly in the equity market and led by the US and developed markets, is still quite a favorable environment and conditions still seem pretty good. I guess since Trump's election, we've seen risk on assets absolutely fly. So we're talking equities, we're talking cryptocurrencies. I mean, the chart on the left-hand side of your screen shows the different asset class performance. And I put in when the US election was, and you've seen this huge rally in that gray bar, which is cryptocurrencies. You've got a lot of positive sentiment, a lot of animal spirits brewing in the air. Trump's a bit of an advocate for cryptocurrency overall. But more broadly, it's been a pretty strong year for equity markets, around about 20 to 25% across the board. We have seen a little bit of pullback in some asset classes like gold, given a rising US dollar. But overall, it still has been a really good month. And what's interesting though, and what's something I'm monitoring a bit more, is what's happening in the bond market. And with that, we've seen inflation expectations rise in the US. And I think because Trump's come in, there's going to be a few inflationary pressures, whether it's from the stimulus coming in, he's pro-business, reducing taxes. So that's obviously quite inflationary. Imposing tariffs on pretty much the whole world is inflationary in itself. And that's where you've started to see the 10-year bond yield actually rise in the US. So it fell quite low to, as low as close to 3 and a bit %. And it's gone a little bit higher since, which is the market saying that, well, hang on, maybe the Fed won't cut as much as what they think. Maybe the inflation genie hasn't been put back in the bottle. So that's something I'm monitoring quite closely over the next 6 to 12 months, especially with Trump coming in January. So that's a little bit about markets, and I didn't want to steal, Dane's thunder too much around what he's giving in terms of the state of the market. But I wanted to talk about something that we're seeing here at Global X, which is this idea of this digital and automation revolution that we're calling it. And I guess it's really this movement from the information age, which happened in the 1990s. We got access to so much information through the internet, and it's really moved to this idea that, now that we have better access to information, and greater models for greater efficiencies, people were still making decisions. And now we're getting into this point where decision-making and completed tasks may actually not be done by humans, but rather from technology. And that's going to increase labor productivity overall to focus on more high cognitively functioned tasks and other types of areas. And I feel that this is where we're seeing this real revolution happening. And it's not just happening at a consumer level, but at an enterprise level as well. So, I mean, we saw the poll earlier, what people are thinking about with leading into next year, what's the most popular theme. I do believe artificial intelligence will continue to dominate. This isn't going to be, I guess, a fad. If you look at something like a lot of you may have experienced with generative AI tools like ChatGPT, it has 250 million weekly active users, which is just crazy. It was the fastest app to reach 100 million users. It did it in, I think, 2 to 3 months, which beat out other tools like when you look at other social media platforms like Instagram, TikTok. So it really shows that people want to use it, and this company is going to generate around about $12 billion of revenue in 2025. So this innovation boom has started. And what you see in each innovation boom, I mean, we saw it during the 1960s with the rollout of the mainframe computer. Then we saw it within the 1980s with the PC, the dot-com boom. And now we're seeing this with this idea of artificial intelligence. You see increased corporate investment in this. And you're seeing a lot of the mega cap tech companies increasing their infrastructure and their capabilities around AI, because the chart on your screen shows that actually this isn't going to be a consumer-led technology. This is a enterprise level led technology, which is why the cost savings in terms of labor productivity is expanding well into the trillions and trillions of dollars leading up into 2030. So I think that with something like this, when you're looking at forecasts, even if we only get a fraction percent of that is still going to be an enormous amount of savings for companies in general, which can then pass on, whether it is in the form of lower cost to customers or branch out into other services. And I think the question that I get a lot when I talk about AI is, but Mark, isn't this like the dot-com boom? Isn't this all going to go belly up and there's only going to be people going to be holding the bag at the end of the day? But the difference between the dot-com boom is the dot-com boom was a consumer-led technology. The internet evangelists were eventually right. The internet did change the world, but I mean, we don't leave our homes without our phones anymore, but we didn't have the infrastructure set up. Whereas now these big companies are investing in their infrastructure to make room for us as consumers to use this technology. And when you look at valuations from a multiple standpoint, going back to the dot-com boom, the valuation of the tech index, which is on the left-hand side of your screen, the orange line, got up to about 70 times price to earnings, which screams expensive. Whereas right now, they don't seem too elevated. And that's because a lot of these companies are really high quality. They've got a lot of cash on their balance sheet. They don't have a lot of debt. They're growing their earnings and growing their revenue. I've seen some great charts comparing the likes of NVIDIA with the likes of Cisco. The reason that Cisco's price fell after the dot-com boom is because their earnings troughed. The reason that NVIDIA keeps going up and to the right is because they are growing their revenue, growing their earnings over time. So it's a very, very different environment from what it was during the dot-com boom. And there's many different ways to play AI. A lot of people just invest in the leading semiconductor companies or the mega cap tech companies. We came out with an ETF early this year, which has actually been one of the most popular ETFs we've had, which is investing in the broad range of AI. So when you think AI, think hardware, so semiconductors like NVIDIA, Qualcomm, SK Hynix, Broadcom, Intel, but then you've actually got the enablers. And these are the companies who are building out the infrastructure and the platforms relating to AI. So you've got companies like Oracle, Amazon, Cisco, IBM. And then finally, you've got these adopters who are leveraging AI to build products and use it as part of their sales kit, whether it be Salesforce, Netflix, Meta, Microsoft. And you're getting very similar valuations compared to the normal S&P 500, but you're getting pretty strong earnings growth on top of that. So far, the AI index is up around about 20% year to date. I mean, we've got this fund in the US and it's a multi-billion-dollar fund, and we've seen around about 40 million come in year to date. So very popular fund and something that we are seeing, probably going to see a lot of traction leading into next year, given that it is quite diverse and it holds up to about 80 to 90 names, which is a little bit different to a lot of the thematic funds, which tend to be more concentrated. The topic that I'm very passionate about, and it seemed like a lot of you on the call as well mentioned it, is not just the AI revolution itself, but what is going to power it. And that's where I think the critical minerals question came up, and around some of these key commodities that's really going to, I guess, fuel this engine. And when you look at it, I talked about ChatGPT to start, which some of you may have experienced with, but just one simple ChatGPT query requires 15 times more energy than a normal Google search. So that to me says that if you've got hundreds of millions of people using this and it requires a lot of energy, well, something has to pretty much power it, and it's not just going to be fossil fuels. And another crazy stat I read, which made me feel quite scary, is that this generative AI technology is expected to generate around about 60% of the world's storable data in the next 5 years. So what that means is us useless 8 billion humans are only going to generate 40% of the data that's going to be stored availably. So the build out of these data centers is deeply, deeply needed. And that's what you're seeing on the chart on your screen, particularly around the share from AI is projected to increase over the next few years to around about 15% in terms of the actual power consumption. And I think that, you know, when you're thinking about data center consumption in the US, it only accounts for around about 2% at the moment. But a lot of these huge companies, and I've been following this very closely, like Amazon, they've just invested $11 billion in a data center infrastructure in North Indiana. Google's done the same with a $2 billion investment in Virginia. Meta's done another one in Wyoming. I also think Google did one in Finland as well. So these mega cap, Magnificent Seven, whatever you want to call them, the smartest companies, best capitalist machines we've ever seen, they know something. They know something, and they are investing in their data infrastructure upgrade because they know that they're going to need it to power this AI revolution. And to power it, you're going to need key minerals, key commodities in there. And one of those is copper. Now, copper is an interesting commodity in itself because it was naturally tied to the economic cycle and to the broader purchasing manufacturing indices. And why it's important is because it was tied to machinery, transportation, and demand, and it's correlated with the global economic cycle, but it has changed to this electrification as we build out our AI capabilities and this grid build out. In fact, 1 gigawatt of power from these data centers requires 65,000 tons of copper. So if we're going to need a hell of a lot more gigawatts, a hell of a lot more data centers, we're going to need more copper. And the copper is not just used in data centers. I mean, it's used more broadly in other types of electrification, like solar panels, wind power generators, electric vehicles as well. So there's estimated to be about a 5 million metric ton deficit of copper leading into 2030, which bodes well for the price. And you're seeing a lot of institutions dial up their positioning within copper. That's the chart on the left-hand side of your screen. But one interesting way to play copper, even though it has actually fallen to around about, I think it's about $4.10 a pound at the moment, copper miners have actually traditionally outperformed the spot price of copper. And that's because a lot of these copper miners can actually use their operating leverage in order to increase their profits. And that's where copper miners themselves, or copper overall, actually bodes well coming into an interest rate cutting cycle. Because yes, as I mentioned before, cutting interest rates normally signals economic weakness, which is bad for copper. Especially if the Chinese demand continues to fall. A year after, you also see favorable outcomes for investing in copper miners, which is why I guess copper has been contained year to date. It hasn't performed as well as some of the other equities. In fact, copper miners, which is our copper miners ETF wire, was up around 15% up until November. But then you saw a little bit of a decrease in price that fell down to that current range. So we feel that for people who want to invest in copper, I mean, you can invest in the big Australian miners who have some copper exposure, but you're missing out on some of the global players in the space across Canada, US, China, Europe. So companies like First Quantum, Glencore, Ivanhoe, Boliden, a range of different companies you can get exposure to. This has also been a very popular fund of ours. We've had about 80 to 90 million come in so far this year. And the performance has still been pretty solid, up 15 to about 17% year to date as well. The final one that I want to talk about just before we go into questions, because I'm just conscious of time, is around nuclear energy. A little bit more controversial, given a lot of people's views around nuclear energy overall. But uranium in itself is a very heavy, dense, radioactive metal, which makes it quite a potent source of concentrated energy. And I think why that's important is because it's a highly dependable form of energy. And that's what the chart on the right-hand screen is showing you, is how much of the time it operates at 100% capacity. And that's done at least 90% of the time. So for these huge companies who are investing a lot in their data center capabilities, they need a reliable source of energy, and nuclear power does have that. Not just that, but from a renewable energy perspective, looking at the left-hand side of your screen, it's actually surprisingly a very renewable form of energy in terms of greenhouse gas emissions, because nuclear energy actually emits the same greenhouse gas emissions as the likes of wind power, and actually less than some other ones like solar or hydrogen as well. So it actually is, one, a highly dependable form of energy, but also a clean form of energy as well. So in order to boost up our current capacity, we need more reactors. And there's currently only around about 430 to 440 reactors that are currently live. Even though that there's 60 currently under construction, which is the chart on the right-hand side of your screen, it does take a lot of time to build out these nuclear reactors, about 20 to 30 years. And that's where you're getting these small modular reactors, these SMRs, which are a lot safer, they're more modular, less expensive. And that's where these big tech companies have been investing in them. You recall that I mentioned Amazon data center that's happening in Indiana. Have a guess why Amazon picked Indiana. Next door to it is a nuclear power plant. So to me, this tells me that Amazon in itself can see that they need some dependable form of energy, and they're going to do that with what they have at their disposal. We saw Microsoft restart 3 Mile Island, obviously very controversial given it was part of the meltdown in the late 1970s. And I think this negative stigma around what happened in Chernobyl and Fukushima is starting to change, because you're seeing a lot of public support now for uranium. And even now at the United Nations Climate Change Convention, you're seeing more countries join their commitment to tripling nuclear capacity leading into 2050. So the uranium market in itself is still going to be in a structural deficit, at least for the next few years. And in Australia, it's a real shame because we've got about a third of the uranium reserves, but we only produce 8% of it. And that's because uranium mining is prohibited in most Australian states. We will see if things change, especially if the Liberals get in next year. But particularly from a performance perspective, uranium went on an absolute tear leading into 2023 and 2024. It has corrected a little bit. There's been a few taxes from some of the Kazakhstan companies. Cameco, leading company, has boosted production. But overall, I'm still incredibly bullish on the proliferation of nuclear energy. And that's why our ATOM ETF, the Global X Uranium ETF, has been a very popular one as well. We've seen around 30 to 40 million come in. It's up around 20% year to date. And I think when you're comparing how to invest in uranium, I think ask yourself an important question. Are you bullish on uranium, the commodity? And in that case, you probably want to own more of the physical uranium market. Or are you bullish on the proliferation of nuclear power? And if the answer to that is the latter, I think that investor enthusiasm is no longer centered on physical uranium itself, but more around, AI power demands, policy support for new technology. So you're getting a lot of these companies like these miners, these machinery, and these construction companies who are critical to these build out of these SMRs. And I think that's where two companies in this portfolio, like NuScale and Oklo, they up around 500 and 200% year to date, respectively. So you're really getting exposure to the broad value chain when looking at nuclear energy. So with that, I thought I'd just close up and just say thank you. I think that next year can be a favorable market, particularly within equities. You're seeing, particularly within the US market, a lot of people are turning more bullish in terms of the upside to earnings growth. But to me, I think that this information revolution to the automation and digital revolution is not going to stop. We're going to see a lot of investment in AI, but more importantly, what's going to power that, AI revolution around some of the renewable energies like nuclear, like the use of copper and other sort of minerals is going to be incredibly important. So hope that was useful and a few insights to you and your team. And I will pause to see if there's any questions.
Thank you, Marc. Very, very interesting insights, I guess. And we already have one question for you on the chat, which is, any copper miners you'd recommend tracking, please?
Yeah, it's a really good question. And I think a lot of people are looking at these single stocks within copper, and a lot of companies, we've seen Australian companies really bid up their ability to get on some of these assets. That's why you've seen a lot of M&A activity in that space. We saw what happened with BHP and Anglo American. The tough thing with some of these copper miners is you're taking a lot of idiosyncratic risk or company-specific risk, particularly on their actual production, on what's happening. And even if the copper market itself actually does quite well, and we are going to be in a structural deficit, if there are particular companies that have any sort of operational failures or any inability to generate some of those margins, you will probably see quite a big dispersion within some of the copper miners. So for me personally, I don't actually track individual copper miners. I actually prefer to own a basket, which is why, and I mean, probably I'm speaking from, I guess, my background over here, which is why I believe an ETF is probably the best way to do it. And the good thing about the wire ETF that we have with copper is it's only going to have a max allocation of around about 5% to each copper miner. So you're not going to get a crazy concentration like you see in some technology funds that have huge positions in the likes of Apple, Nvidia. So you're getting a broad range of different exposures to dozens of different companies that are all part of the copper value chain. They either involved in copper mining activities or they have reported activities in copper. So for me, one of the best ways to play it, you can invest in pure copper. It does have a spot market a bit different to the likes of other commodities like gold. But I think copper miners are an area, especially next year, that can be a really interesting play, but picking those individual companies are quite hard. So for me, I take the intellectual humility approach and go for own all the copper miners rather than picking one.
Maybe time for one or two more questions very quickly. Thank you. Yeah, please feel free to go off mute or put it in chat.
Just one from me, Mark. Thanks for that presentation. That was excellent. You talked a little bit about the flows you were getting into those ETFs, but broadly across your suite of ETF products at the moment, what's kind of attracting the biggest inflows? And conversely, what are you experiencing the biggest outflows in?
It's a great question, Dane. And I mean, this year for itself, ETFs have already surpassed their record year for inflows ever, better than the years that they had during the COVID years. But to answer your question, we have seen quite an interesting, I guess, movement within certain areas. As the bond yields have started to rise, I mentioned the US, we have seen a little bit of money leaving some of the US Treasury bond ETF that we have, our USTB. So a lot of people aren't sure, you know, like I said, because usually when interest rates rise, it bodes quite negatively for bond prices. So a lot of people who are playing that duration trade, we've seen a little bit of selling. Gold's also been an interesting one because gold in itself has been at record, it's now touched record all-time highs, but a lot of people are still positioning in gold, even though, and it's a weird conundrum because normally what happens is when interest rates, when the US dollar rises, gold tends to fall. And pro-Trump, we've seen the US dollar rise, but gold is still sticky over there. It's still heading in the right direction. And I think that's because whether it's real yields falling, whether it's geopolitical risk, we're seeing potential. I know there's been a ceasefire that's been agreed to in Israel and the Middle East, but there's just so much tension that gold in particular, we've seen a lot more flows, first of all, from the institutions, then the actual OTC market, over-the-counter market, and now coming to ETFs. So we're still seeing some sticky flows in gold. And probably just the other one to highlight, Dane, is we're still seeing some regional exposure. So a lot of people are really liking India overall as the leading emerging market. So that's our NDIA fund. Europe, interestingly, even though there is a bit of concerns around certain economies like France in particular, I know that their bond yield is just gone out a lot higher compared to other nations like in Germany. We're still seeing a lot of interest there. And then finally, I know I did talk about GXAI, which is our AI fund, but if you are still convinced that the mega cap tech stocks, the Magnificent Seven, are going to continue to lead the way, which I do think that they have incredible power, our FANG ETF, which holds these mega cap tech companies and a few others, has also seen quite a bit of flows. And then the last one I thought I'd highlight, Dane, is one that I've actually been quite surprised with, is silver. Which is our ETP MAG ETF. Gold is naturally the commodity that a lot of people move to from a safe haven perspective, but just because of the industrial application around silver, it's used in a lot of different, from a renewable energy perspective as well, in these PV solar panels too. A lot of interest in silver, and also the gold to silver ratio is at quite a discount at the moment. So a lot of people are saying, well, in order to close that discount for a bit of mean reversion, a lot of people are playing the silver trade at the moment. So yeah, quite a vast different range across our product range. We are planning on also coming out with a few more products next year. So yeah, definitely keep on the lookout for that. But yeah, very mixed across the board overall, but it has been a very positive year for us. And again, I would be remiss of me not to say that we have seen some money into our Bitcoin ETF following the huge rise up in that product as well, hitting close to 99,000. So yeah, still a lot of interest in some of these alternative assets too.
Thanks,
Thank
Mark.
you. Thank you, Mark. I guess in the interest of time, if there are no more questions, we'll keep moving, but really appreciate you joining us this morning, and we'll get to the final part of the presentation this morning then.
Thanks, guys. And same with, as Arjun said, if anyone has any questions, I'm also on LinkedIn. Feel free to reach out. And yeah, really appreciate the time, and hope you have a great rest of the day and good weekend too.
Thank you very much, Mark.
Thank you. Okay, so for our final part of our presentation, we have now Dane Pymble. Most of you know Dane, so probably don't need too much of an introduction, but I'll do some introduction. So Dane's got a 20-year career in funds management, has been on the investment committees of BT Private Portfolio Management and Infinitas Asset Management, which he was a co-founder of, and recently sold it to Alvia Investment Partners. At Own Financial Planning, Dane leads our asset allocation service and portfolio construction strategies. So I will hand over to Dane to talk a little bit about how we incorporate all the insights which we have shared from different experts today into our model portfolios.
Thanks very much, Aadil. You could spend the next 20 minutes still talking about me. That's my favorite topic, if you feel like it, but I'm sure the audience probably aren't as interested in that. But thank you. So essentially today I'm going to talk about three things, and that is the long-term market cycles research that we draw upon for the asset allocation services that we roll out. So some of you on this call today are quite familiar with that research, and many of you aren't. For those that are, this will be quite a high-level overview of that research, and we can certainly talk offline in more detail for those that have that interest. Secondly, we're going to talk about the key themes and investment opportunities that we see based on that research for 2025. And then we'll run through the asset allocation strategies themselves and how they've performed thus far. So, not surprising, quick disclaimer, today is very much about general advice. When we're sitting down with you individually, your individual personal goals come first, market cycles very much second. So, starting with the background behind the research methodology that we use, the primary source of influence that we use to construct the components of our asset allocation strategies draws upon the team at Property Share Market Economics, led by economists Phil Anderson and Aadil Patel. And so for those not familiar with them, I really encourage you, if it is of interest, to check out their website, and they have research subscriptions available. They've also authored a couple of books, and if I was starting out learning about market cycles research, I'd highly recommend starting with Aadil's book, simply because it's a very practical application of how to use cycles research and apply it as an investor. Phil's book's great as well, but it's a very academic piece. And so the central premise of the research is that the realization that whilst history doesn't repeat, it certainly rhymes. And their research demonstrates, which you can see in the bottom left of the screen, that economic cycles throughout history run typically on average around 18 to 20 years in length. And at various stages of the cycle, different themes have a tendency to dominate. And so we draw on this research to construct a diversified portfolio of investments that best reflect the themes expected to perform well at the present stage of the cycle. And then as the cycle progresses, we actively recommend changes to these positions so that you remain at all times, from our perspective, as best as possible exposed to those relevant themes. So where are we now in the current cycle? And we've heard some really great presentations around some of the opportunities that present, and certainly the way we see the world in many ways complement those perspectives. So just looking at this chart, this stylized chart, the really key thing to highlight here is not all markets and asset classes are going to rise and fall at the same time. That is, I mean, everyone, I'm sure, intuits that and knows that. And then the other key point I want to highlight here is I'm reminded of a quote by famous sort of fund manager Peter Lynch, is that a lot of money a lot more money has been lost waiting for markets to crash than the market crash itself. So it is important to not sort of over focus on one part of the cycle being the end of cycle. But the key themes that we sort of see at the moment is that we've moved past what we characterize, or what's characterized in the research as a mid-cycle slowdown. So that was what we experienced during that COVID correction starting in 2020, but also that decline through 2022, where all asset classes declined, including the defensives such as bonds, etc. Last cycle, just to give you some context, the equivalent mid-cycle last cycle was the dot-com correction, the dot-com crash, where equity markets were heavily affected. However, the property market, particularly residential property, was relatively unaffected at that stage of the cycle. And that's, if anything, it actually turbocharged the property boom at that point through the interest rate cuts that happened then. And you've seen very similar themes play out this cycle as well. So right now we find ourselves kind of well into that second half of the economic cycle, which is often the strongest growth phase for growth markets, heading towards the next peak. And I echo again my point, not all markets are going to peak at the same time, but typically, and this is what this research is founded upon, it's typically US housing that will signal the problems that may be coming for the rest of the global economy. And so referencing last cycle, that kind of started around 2006, mid-2006, US housing peaked. However, global share markets didn't peak until late 2007. And interestingly, Australian property, and you've seen from Arjun's presentation that there's still low levels of debt, strong market pressure. Australian property is actually a lagging indicator. It peaks, differences from capital city to capital city. Sydney certainly has peaked earlier historically, but particularly Brisbane, Adelaide, Perth have peaked much later in the cycle. So we could see 2028, 29 even for both equity markets and residential property market peaks outside of the US, that is. And so the next phase of the cycle, and it's certainly how we're aiming to position our asset allocation portfolios, we expect some transition in market leadership. And so, and I know Marc did speak about this and still feels very strongly about it. We feel that the dominance of the mega cap tech companies like Apple, Microsoft, Amazon, Google, etc., we expect sort of the relative rates of growth to give way to other key themes, such as that we've highlighted on this slide. So real estate, both residential and commercial, but it's really the time where commercial property comes and shines in the later stages of the second half of the market cycle. Financials such as banks and insurance companies and infrastructure. And you saw in Arjun's presentation, infrastructure spending at the moment is at very, very strong levels. Not surprising, that's how the cycles typically play out. We also like commodities, precious metals, mining companies. Mentioned in Marc's presentation, we own the Wire ETF in our asset allocation strategies. Smaller companies start to outperform larger caps, and similarly, emerging markets such as India and others like it start to outperform the developed markets as well. Not as uplifting a theme and not something that we enjoy, but the reality is that there's typically you just have to see the news, that there's a war and there's a cybersecurity element that is going to prevail and probably continue to have pressure on as we head further into the end of the cycle, particularly that wealth disparity that happens when asset markets grow. It highlights the divisions. So, and if you've got any questions, I'll certainly address them at the end. But I wanted to jump now. That's kind of the background behind sort of the research methodology and some of the investment themes that we like. I want to jump now to talking about the different styles of which you can invest. So it's important to sort of, when considering this, that there's a range of different ways that you can invest, and that's not necessarily the risk component. The risk is more how much you mix a portfolio between, defensive and growth. But once you've chosen that mix, be it high growth, or whatever, or balanced or conservative, then it's what style how would you like your investments to be managed? So we're going to talk about 3 of those portfolio construction styles: index, core satellite, and active. And to address Andrew's question around copper miners, one of the things that we're big believers, and it's something that personally I changed my opinion on through my career, is that unless you are a dedicated asset manager focused on copper miners, as an example, most of your return long term is going to come from asset allocation itself. And so in our philosophy, we focus on the asset allocation part, and we leave to the experts in the particular areas that have that expertise to focus on which copper miners are going to be better than the others. And that would be an active approach. But just high level, just to explain the 3 construction styles. So starting with the index approach. So a pure index approach seeks to give you a return of the index, and whatever that index happens to be, at the lowest possible cost. So unlike active managers that are seeking to outperform an index, and that could be risk profile based, the high growth index, growth, balanced, or it could be a particular market such as Australian shares, the ASX 200 index as an example. And so typically a pure index approach is the middle ground in terms of expected performance, and typically the lowest cost. There's minimal manager risk, as the manager's there purely to construct a portfolio to replicate the index, and your risk lies with the performance of the index itself, not the manager's selection of investments. And then jumping across to the right of the slide, the active approach is seeking to outperform a chosen market, such as the ASX 200 as an example. And so active management provides for the potential to outperform a chosen index, and by default, this also means that there are risks that it can underperform. So typically, active management comes with higher costs due to the greater research requirements in identifying the opportunities to outperform. It does also come with a greater degree of manager risk, and in that you are reliant on that specific manager or managers that you've selected to perform better than the equivalent index option to justify these higher costs. So now turning to the middle, core satellite. So a core satellite approach aims to achieve the best of both worlds, at least in our opinion. It combines an index approach at the core and takes a more active approach with the satellite positions in the portfolio. So if we think of the core as the sun and the satellite as planets orbiting around the core stays relatively stable through the cycle. It's the index, and typically, it's invested in a pure index strategy or something closely reflecting that. And then the aim with the core is to minimize the cost and transactions embedded in the portfolio itself. And then the satellite is the more active component of the portfolio, and there's a range of different ways a satellite portfolio can be put together, but in general, it is the more active part. So then how do we do that? So, and any of our clients would kind of understand this. Our starting point for you as individuals and families is really to understand your life and the goals that you're trying to achieve first. Before we even, this is an outcome of that advice, not the service in and of itself. So once that's well and truly understood, and once we understand the risk tolerances relevant to executing on achieving those goals, then it's about considering, well, okay, well, what style of management's going to fit for your comfort. And so we have 3 different strategy options for clients to consider. The first being a pure index approach, And that's for those that just want a simple, low-cost solution. And remember, this isn't an all or nothing. There can be different elements of your investment strategies that could be index and other parts you might be more active. And so for both of we've got 2 core satellite strategies, and for both of those strategies, we've partnered with iShares Enhanced Strategic Models to act as the core. It's not a pure index. It's actually got a 7-year plus track record of outperforming the index, but it walks and talks very much like an index, and it's quite low cost. So for core satellite passive, this strategy where the satellites that we put together as part of this portfolio, drawn upon that market cycles research, are essentially low-cost ETFs, examples of which were like the Wire ETF that Marc spoke about earlier. And that's really trying to allocate to the theme, and generate performance by the theme doing better than just the broader index itself, rather than trying to pick the winners within that theme. Then core satellite active. So this portfolio is similar to the previous. However, it also includes active fund managers with a long-term track record of performance in their respective themes. So what we're trying to highlight here is we spend all of our time absorbing market cycles research and aiming to put together portfolio options that reflect that research, but not trying to agonize over whether BHP is going to outperform Rio Tinto. We leave that to active fund managers that focus on that area of specialty. And so for all of those 3 strategy options, they're available across all the main risk profile levels, being high growth, balanced, and conservative. So for both of the core satellite strategies, we are seeking to outperform an index approach through the management of the satellite components of the portfolio by identifying those themes, and also fund managers that have a tendency to perform well at various stages of the market cycles.
Dane, I'll just do a quick time check. We're coming up for time, so maybe in a few minutes.
All right, we're on the final stretch. This is my favorite slide. This is the ego stroke. Don't get too caught up in this. The strategies have been running for almost 18 months now. So yes, we are pleased that they have been performing well relative to their index. In fact, all of our strategies across all the risk profiles have outperformed the index. So I guess the thing to draw from that is that we spent a lot of time when we put together this business and aim to develop this solution to design portfolios that are going to do what it is that they're designed to do. Now, markets will play out and as they do, and I've presented a research methodology that aims to forecast the future direction of markets. But like I said earlier, it's really important not to get too caught up. It's particularly in the end of cycle. And I know there are questions that come. I know a lot of them often are about what's going to happen in the crash, how do we position, and all of that. I think you can expect that there's going to be difficult periods to navigate through that time, no matter how well you forecast the future direction of markets. And it's something that I don't think gets highlighted well enough by the real hardcore market cycles aficionados. But there's a very strong difference between forecasting markets and managing portfolios to generate returns in those markets. They're 2 extremely different skill sets. But that's all from me. Thank you very much for indulging me in this discussion. I'll hand it back to you, Aadil, if we've got any questions.
Oh, thank you, Dane. And I think, yes, if anybody has any questions for Dane or about our asset allocation services, you're welcome to kind of ask some questions now, or as most of you know where to sort of find us as well. You can send us an email, follow us on social media, and we'd be happy to share some further insights and try and discuss how we can start to incorporate a bit more active approach to your portfolio management.
Thanks, everybody.
That pretty much completes. We are at that's the formal part of the workshop. So we hope you got some valuable insights this morning, and thank you all for joining us this morning. And yeah, we'll hang around for a few more minutes, but if there are no more questions, we will then sign off in a few minutes.
Thanks very much.
Thank you,
Appreciate all
everyone.
your comments.
Dane, just a quick one for you. John here.
G'day, John.
Right, it's just a question in relation to your portfolios. Are you just taking long positions, or are you also taking short positions in those?
Good question. It's something that we discuss internally. It's not a long-short strategy per se, but it has the capacity to invest in funds and ETFs that can generate return inverse to the market. So examples of such as the Bear ETF that is
Yep.
to the equity market. So it certainly is not the way we're positioned at the moment, because at this, as you would probably deduce, at
This point in the cycle, yeah, for sure.
Very strong growth phase. So, and I guess underlying that question, as we get towards the phase of the cycle where there is expected to be a downturn similar to the GFC, I think at that stage, the aim that we're trying to achieve there is more preservation of capital as best we can. There will be volatility. There will be no fund manager that will generate, other than by pure chance, then they will generate strong performance through that period. And I feel very strongly about that, no matter how it may be differently positioned. However, where you can potentially generate positive returns can be through examples like you highlighted, but also other simpler ways. In the currency is not something that we've discussed greatly today, but typically the US dollar starts to underperform our domestic currency and currencies similar to it in the second half of the cycle. Conversely, when we get towards those downturns, there's often a flight to safety currencies, and in spite of a lot of the rhetoric around government debt and whatnot, the US dollar is seen still, and we expect for the foreseeable future will continue to do so, will see itself as a safe haven. And so as an Australian investor, you can actually generate a positive return by having a US dollar exposure, as an example. So there's I'm not sitting here today knowing with crystal clear vision exactly how we're going to position our portfolios at that time, but they're examples of what I think about. That, and other things like treasury bonds, in a declining interest rate environment, the value of bonds typically go up too. And so it's not that we're just going to be sitting on our hands in cash for a couple of years. There'll be stuff that we'll be looking to allocate to, but I would imagine it's going to be predominantly from the perspective of preserving capital, even for the high growth strategies who traditionally in the industry just stay fully invested through the cycle. But that's something Aadil and I argy-bargy about all the time, and I'd suffice to say I probably individually spend way too much time thinking about 2, 3, 4 years from now. The focus is very much on the present. That's where the results come. So it's always bringing it back to, okay, that's great. That's what might be coming. But the focus is, okay, well, in the next 6 to 12 months, how should we be positioned? And are those positions performing how we expect them to be? Does that answer your question, John?
It does indeed. Thank you, Dane.
You're welcome.
Yes.
Any other questions?
No more questions, Dane, right now. So I guess we can wrap it up for this morning if there are no more questions. I know there are a few more people on the line, but otherwise we will formally close this particular morning session.
Thank you all.
everyone
This is our
for
last
joining.
workshop for the year. Merry Christmas, Happy New Year for all of those that we won't get a chance to speak to before then.
Thank you, everyone, for joining. Have a great day, good weekend, and speak to you soon.
Thanks, guys. Bye now.
Thanks a lot. Bye.
Thank you. Bye-bye.